Most traders don't lose money in a gold or silver crash because the market collapses. They lose because they panic. The moment price starts falling hard, everything changes. Screens turn red. Positions that felt safe hours ago suddenly feel dangerous. Stops that were definitely going to be respected start to look negotiable. Traders tell themselves this move is too extreme, that gold shouldn't be dropping like this, that silver always bounces. And in that moment, discipline quietly disappears. Every gold and silver crash looks the same from the outside. Sharp moves, fast candles, heavy volatility. But on the inside, the experience is very different depending on the trader. For most, it feels like chaos. They overtrade. They add to losing positions. They widen stops or remove them completely. They chase moves they already missed. By the end of the session, accounts are damaged or wiped out, and the explanation always sounds familiar. Bad luck, manipulation, unfair moves. At the same time, a smaller group of traders watches the same crash and has a completely different experience. They don't enjoy it. They don't feel clever, but they stay controlled. Their risk was defined before the move started. Some take small losses. Some stay flat. Some even catch clean trades because volatility finally gave them what they were waiting for. They don't blow accounts. They don't spiral. They survive. And survival in a crash is not failure. It's the difference between staying in the game and starting over again. This is the part most traders don't want to face. The crash didn't single them out. The market didn't suddenly turn against them. Gold and silver didn't behave irrationally just to punish their position. The same crash that destroyed one trader barely touched another. Same market, same movement, completely different outcome. Gold and silver are especially dangerous during moments like this because traders trust them. They see them as protection, as stability, as markets that aren't supposed to fall aggressively. So when they do, the emotional shock is stronger. The belief breaks before the position does. And once that belief cracks, panic takes over. What keeps repeating isn't the crash. It's the behavior. Every major move exposes the same weakness. Traders who don't follow discipline lose control. Traders who overtrade magnify the damage. And traders who rely on hope instead of rules learn the same lesson again, at the worst possible time. To understand why this happens every single crash, and why only a few traders come out intact, you have to look past the price and into the psychology behind panic. Part 2. Why panic takes over in metal crashes. When gold and silver start collapsing, traders reach for explanations that make the pain easier to swallow. They talk about manipulation, about central banks, about unexpected news, about how this move shouldn't have happened. But none of that explains why the same crash wipes out one account and barely scratches another. The real difference isn't the market. It's the behavior that shows up when pressure hits. It's not a lack of experience. Many of the traders who panic have been trading metals for years. They know the sessions. They know the levels. They know how volatile gold and silver can be. And yet, when price accelerates lower, all of that knowledge becomes useless. Knowing what to do and being able to do it are not the same thing, especially when emotions are loud. It's not capital either. Small accounts blow up quickly. Large accounts bleed more slowly, but the end result is often the same. Bigger size doesn't create more discipline. It amplifies whatever behavior is already there. If a trader tends to hesitate, panic, or overreact, more money just turns those habits into bigger mistakes, and it's not opportunity. During crashes, opportunity is everywhere. Volatility creates clean moves, wide ranges, and clear reactions. The problem isn't a lack of chances. It's the inability to engage with them without losing control. Gold and silver crashes expose a specific kind of identity problem. Many traders don't just trade metals. They believe in them. They see gold and silver as protection, as stability, as markets that behave differently from everything else. So when price starts dropping aggressively, it doesn't just challenge a position, it challenges a belief. And when belief is threatened, emotions escalate fast. Think about the undisciplined trader going into a crash. Before the move, confidence is high. Positions are larger than usual because gold feels safer. Stops are loose because silver always comes back. There's comfort in the narrative. Then price breaks hard. The first drop creates surprise. The second creates discomfort. The third creates fear. Suddenly, the trader isn't managing a trade, they're trying to defend a belief. This is where discipline usually collapses. Stops feel too far away to take now. Losses feel temporary. The trader starts thinking in terms of what should happen instead of what is happening. They add to positions to get a better average. They hold losers longer than planned. They promise themselves they'll exit on the next bounce. But the bounce doesn't come. And now panic turns into damage control. Contrast that with a disciplined trader watching the same crash. They didn't assume gold or silver owed them stability. They didn't size up because of a story. Their risk was defined before the market moved. When price broke key levels, their stops were already placed. If they were wrong, they were out. If conditions didn't match their plan, they stayed flat. There was no internal argument because the decision was already made. This difference matters because panic is rarely a sudden event. It's the result of small compromises stacking up. One rule, bent here. One exception made there. One oversized position justified by confidence. When the crash finally hits, the trader isn't starting from a neutral place. They're already exposed, emotionally and financially. Gold and silver crashes also trigger panic because of speed. These markets can move violently in short periods. Candles expand, spreads widen. Everything feels urgent. Discipline, by comparison, feels slow. It feels like it can't keep up. Traders start thinking they need to react faster, not more carefully. That's when they abandon structure and start chasing price. Another factor is regret. Many traders had profits earlier in the move. Watching those profits disappear is often more painful than taking a fresh loss. The mind fixates on what was. I was up earlier. I should have taken it. That regret pushes traders into bad decisions, trying to get back to where they were emotionally, not where the market is now. This is why gold and silver crashes keep producing the same results, not because traders don't learn, but because they don't change how they behave under pressure. They tell themselves next time will be different, that they'll be calmer, that they'll follow rules. But when the next crash comes, the same emotional triggers appear and the same reactions follow. The disciplined trader isn't braver. They're not calmer by nature. They simply remove the conditions that create panic. Smaller size, clear rules, fewer trades, no emotional attachment to direction. When the crash arrives, they don't need to become disciplined. They already are. Until traders stop relying on hope, belief, and reaction, crashes will keep doing what they've always done. They'll expose impatience, punish overconfidence, and reward those who respected risk before the market forced the lesson. And this is where the real story of every gold and silver crash begins. Not with the price movement itself, but with how discipline holds or breaks when everything speeds up. Part 3. What the crash really exposed. By the time gold and silver were moving fast, the damage for most traders had already been done. Not by the drop itself, but by everything that came before it. The crash didn't create bad behavior. It revealed it. When volatility exploded, traders didn't suddenly become reckless. They simply defaulted to who they already were under pressure. Gold and silver are brutal teachers because they don't fail slowly. They move with speed and conviction. That speed strips away comfort. There's no time to slowly adjust or gently rethink decisions. Whatever habits a trader has built get amplified instantly. If they respect risk, that discipline shows up. If they rely on hope, that hope gets punished fast. One of the strongest forces behind panic in this crash was the illusion of safety. Many traders treat gold and silver differently from other markets. They size larger. They give trades more room. They convince themselves these markets are fundamentally supported and will eventually recover. That belief works fine in calm conditions. But when price starts falling aggressively, that sense of safety collapses. And when safety collapses, fear takes its place. Another force was speed. Fast markets overwhelm the part of the brain responsible for rational decision-making. Candles grow larger. Levels break faster than expected. Stops get hit quickly. In that environment, discipline feels too rigid. Traders start thinking they need to react, adjust, intervene. They move stops. They add positions. They abandon the plan in an attempt to regain control. What they're really doing is trying to slow down an emotional response in a market that doesn't wait. Position size played a bigger role than most traders want to admit. Oversized positions turn normal pullbacks into emotional shocks. A move that should have been manageable suddenly feels catastrophic. Panic isn't caused by price alone, it's caused by exposure. When risk is too large, every tick feels personal. That's when traders stop thinking in probabilities and start thinking in survival. Regret also fuels panic during crashes. Many traders were sitting on unrealized profits before the drop accelerated. Watching those profits disappear creates a specific kind of pain. It's not just a loss. It's the feeling of having had something and letting it slip away. That regret pushes traders into bad decisions, trying to get back to a previous emotional state, rather than responding to the market in front of them. While all of this was happening, disciplined traders were having a very different experience. They didn't enjoy the crash, but they weren't surprised by it either. Their size was controlled. Their risk was predefined. Some were stopped out quickly and moved on. Some stayed flat and avoided the chaos entirely. Others were able to take advantage of the volatility because it finally aligned with their rules. They didn't need to predict the crash. They just needed to respond correctly once it was underway. This is the part most traders misunderstand. Discipline doesn't mean you always make money in a crash. It means you don't lose control. It means losses stay small, decisions stay clear, and emotions don't hijack execution. In extreme moves, that alone is an edge. Crashes are stress tests. They compress weeks of emotional pressure into hours. They remove the luxury of comfort and expose how a trader actually operates when there's no time to hesitate. That's why the same traders keep blowing up accounts every time these moves happen. The market changes, but their behavior doesn't. When gold and silver fell hard, the difference wasn't strategy. It wasn't analysis. It wasn't intelligence. It was whether discipline was already built into the process or something the trader hoped to access when things got uncomfortable. For those who followed their rules, the crash was manageable. For those who didn't, it was devastating. And once the dust settled, the pattern was clear again. Panic punished impatience. Discipline protected capital. What matters now isn't replaying the move or arguing about why it happened. What matters is understanding what it revealed. Because the next time volatility hits, the market will ask the same question again. And it will do it without warning. The only real choice traders have is whether they answer it with panic or with discipline. Part 4. Who survived and what comes next? Once the dust settles after a crash like this, the outcomes become very clear. Some traders are exhausted, frustrated, staring at accounts that are badly damaged or completely wiped out. Others are still standing, not euphoric, not celebrating, just intact. And in markets like gold and silver, staying intact during violent moves is already a win. The traders who lost the most weren't unlucky. They weren't singled out. They followed a familiar path. They ignored position size. They treated rules as flexible. They traded emotionally as price accelerated. They averaged into losers, chased late entries, and tried to fight the market instead of managing themselves. When the move finally ended, the damage was done. And this isn't new. The same traders tend to blow accounts every time a crash like this happens, because the behavior never changes. On the other side, were traders who respected discipline before the crash even began. Their risk was defined. Their exposure was controlled. Some took small, planned losses and moved on. Some stayed flat and avoided the chaos completely. A few managed to capture parts of the move because volatility finally lined up with their rules. They didn't need to be perfect. They just needed to not panic. In extreme markets, that alone is enough to separate survival from destruction. This is where trading and investing start to diverge. Traders who panic see crashes as disasters. Disciplined traders see them as stress tests. Long-term investors see them as something else entirely. To an investor with patience, a crash isn't an ending. It's a reset. Price falls faster than perception can adjust, fear replaces logic, and value gets repriced. What feels like chaos to a panicked trader often becomes opportunity for someone willing to think in years instead of days. That doesn't mean buying blindly or ignoring risk. It means understanding the difference between short-term fear and long-term perspective. Gold and silver haven't stopped being what they are because of one violent move. Markets breathe. They expand and contract. Crashes clear out excess, flush out weak hands, and create conditions that didn't exist before. The traders who survived this move didn't do anything dramatic. They didn't predict the crash. They didn't outsmart the market. They simply followed rules when it was hardest to do so. And the investors who will benefit going forward won't rush either. They'll wait, assess, and act when fear has done its job. Every crash delivers the same lesson. Panic is expensive. Discipline is protective. And patience changes how you experience markets entirely. You can't control when gold or silver will move aggressively, but you can control whether you react emotionally or respond with structure. If there's one thing to take from this move, it's not where price went, but what it exposed. The market didn't change. Behavior did. And the next opportunity, whether as a trader or a long-term investor, will belong to those who kept their discipline when others lost it. If this way of thinking resonates with you, keep following the channel as we share more insights, trading stories, and trading motivation tips in future videos.